All right, next question comes to us from Jordan. And Jordan, you asked a bunch of questions, but we're only going to answer the last one because it's our show. All right.
But we still love you, Jordan. Thank you for writing us.
We're only answering question number 3. Some of my stocks have really plunged, and I'm worried that they were bad investments, such as SolarCity and Baidu. I was thinking about placing a limit order so that I would not lose all my money. Do you suggest placing limit orders so that if a stock loses more than half the value, then it sells automatically?
So let's talk a little bit about orders. If you go online in your broker's website and you click, you want to buy or sell this stock, you're probably putting in what's called a market order. So your broker's then going to go out and execute that trade at the best price possible. So if, let's say you look at the stock and it's quoted at $50, you place that order to sell it. You may not get $50. The broker's going to try to do his or her best. But it's going to be close for most stocks, especially particularly liquid stocks. You can also
like pennies.
Right, yeah. Within pennies, especially anything that's in the S&P 500 or anything like that. You want to explain that there are other versions like a limit order.
Sure. Yeah, and so a limit order is a good tool. I use a limit order to buy into stocks just because, especially with the volatility that we've experienced in the market, if you have some sort of known value for the price you want to pay for an investment, it just helps get that price instead of letting the market makers decide. And especially now with high frequency traders, a lot of brokerage firms will front run market orders where they'll get pooled information about the market orders that are in place, and then they will trade in front of you. Now, again, it's just pennies, but to them, that's a lot of money. So I like to put in limit orders. And again, just to define limit order, a limit order is the ability to, instead of saying, please just go out and buy the stock at the given price currently, buy it at a very specific price. You could even say $30.01, just to make sure that you get it very close to $30.01. And then if it moves into that range, it'll execute.
Trigger
right.
it.
And the risk, of course, is that it doesn't, and then you don't get that trade. Now, what he's doing is he's employing the strategy to put a price below a stock, saying they bought it for 100. He's like, okay, but if it drops to 50, I want out. Generally speaking, at the Motley Fool, we're not big fans of this for 2 reasons. First of all, you've just locked in the loss. And we are long-term investors. Some of the best investments in Motley Fool history have been investments that have dropped 70, 80, 90%. But someone here at the Fool, usually someone like Tom and David Gardner, have held it for 20 years, like Amazon. Right.
All this.
And it presumes that if you still like the investment, if you don't like the investment, then maybe you should just sell it anyhow. But if you still like the investment, but you put in this limit order, you're going to get sold out of it. And then you have to then make the decision, okay, what's the right price to get back in? What if it then pretty much immediately rebounds and you've locked in that loss and then you missed out on some of the gain? So for the most part, from our investment strategy of buying and holding good businesses, we generally don't use them to get us out of a stock when it drops too much.
And I feel you, brother. I own SolarCity myself. It's painful right now, but I'm going to hold on to it because I believe in the company. Not saying you should, but I'm there with you.
Right. And many people at the Motley Fool are, especially with Baidu too as well.
I always like the advice here at the Motley Fool where when you buy a stock, get a little piece of paper or keep a notebook and write down like the 3 reasons why you like that stock.
Yeah.
So that then when the price declines, you look at your little Post-it and you check to make sure that your investing thesis, are those 3 points still true? Okay, then I'm holding on.
Yeah.
If they aren't true, all right, let's go ahead and sell.
This sort of gets back to risk tolerance, but anytime I buy an investment, I just buy knowing at some point it is going to go down 50% or more. You hope it doesn't, but that's just part of the game. You just have to know that is possible. It's going to happen somewhere in your portfolio. It's just a given.